Just take it away.
All right. So I'm going to start today with our tax agenda. We're going to cover tax structuring, some ideas to help you think through what kind of legal entity you want to have as you're starting your business, some of the tax forms, some tax planning ideas, and then also some pitfalls or things you want to make sure you avoid as you're getting your business off the ground, and then hopefully some other taxes to be aware of. There's a lot of different taxes that fall that companies have to deal with, from property tax, payroll tax, income tax, sales and use tax, and just wanted to touch on each one of those to make you aware of their existence. So here's my contact information. Email's pretty simple, casey.tanner@ey.com. I'm more than happy to field any questions you might have at a later point. You can also reach me at the respective phone numbers here. So we'll start off with the partnership tax structure. So believe it or not, when you start a business, if you go in business with a friend or family member, you may inadvertently create a partnership unintended. But by the eyes of the IRS, if you and another party go into business and decide you're going to contribute money or contribute assets to develop something, you have created a partnership. And so the benefits of a partnership is you have maximum flexibility on how are you going to allocate profits and losses. This is why a partnership structure can be so appealing to investors at many times, because you can allocate different components of the income or loss that a business creates, such as depreciation or credits, to certain partners, because certain partners or certain investors would be interested in different types of attributes that can come through a business, and a partnership provides that vehicle. The other benefit to a partnership is that it's a pass-through entity. So in the early days of a business, typically you don't make a lot of money, and so losses are generated. These losses are utilized because they're passed through directly from the legal entity to the investors or to the partners, and are going to be claimed on their individual income tax return. And so those losses can be utilized to offset other sources of income in the early days as the business is getting started. The other benefit to this, which makes it so appealing to other investors, is that when a new partner is to join the partnership, they can get a step up in basis of all the underlying assets in the partnership. And so if you've created your small business, you started with $100, 3, 4, 5 years later, you've created some intellectual property that's now worth $1 million. When a new partner comes in, they'll get a step up in basis to what the fair market value is of the underlying assets in the partnership that they can claim and recover through depreciation. So a partnership is a very appealing legal entity for investors. The last item that I want to mention is that previous to in 2018, there was the Tax Cuts and Jobs Act, which essentially reformed our income tax system. And you had individual income tax rates that peaked at 35%, and the corporate tax rates were at 35% as well. Well, part of the Tax Cuts and Jobs Act, that lowered the corporate tax rate down to 21%, and it raised the individual income tax bracket by about 37%. And so in order to equalize this arbitrage between what the corporate tax rate is and the individual income tax rate, they created Section 199A, which allows for a 20% deduction on qualified business income. And so not only does the income be passed through, but you get to take a deduction at a reduced rate, so that the partnership taxation regime and the corporate taxation regime have much more similar income tax rates that are being applied to that income or loss. The next structure is the corporate structure. So this is probably the structure that most every publicly traded company has. The benefits of the corporate structure is it's easy for investors to come on board. So every, if you were to go buy a stock in a company on the NASDAQ or the New York Stock Exchange, you're just buying shares of stock. So you're buying partial ownership in a corporate structure. You can have stock options so that your employees can get shares of the stock and have equity equity or ownership in the company. But the downside to this is the double taxation. So what that means is that as a closely held corporation, the corporation itself is taxed, unlike a partnership. A partnership is not taxed because all the income and loss flows directly to the partners, and then they pay tax on their personal tax returns. At the corporate structure, the corporation itself pays a tax at 21%. Now that money is kept in the corporation until there's a distribution or a dividend sent out to the shareholders. A recipient of a distribution or a dividend is taxed a second time on your personal tax return. So there's a double taxation that exists at the corporate level, which makes it a little bit less appealing. But it is easy for investors to take ownership of it, just like any one of us can go through E-Trade and buy shares of stock in a publicly traded company. So it makes it easier for investors to come in, but the other side is the double taxation. There is a 1202 exclusion, which is a small business stock. So if you are a qualified small business stock, when you sell that stock, you can avoid paying tax on the gain from that small business stock. So the IRS created Section 1202 to really appeal to investors to make an investment in small businesses to avoid that gain on sale of owning small business stock. The other downside to a corporate structure is Section 382, which limits the ability to use net operating losses. So if you remember how I mentioned a partnership, they can utilize losses immediately because they're passed through to the partners. In a corporate structure, Section 382 says a corporation itself has created losses. Let's say during the first 5 years of the business, you've lost $100,000. These NOLs are tracked. Now you've brought in different investors. Other shareholders have come in and joined the corporation. In the eyes of the IRS, that could potentially create an ownership change, which then says, we're going to limit how much of those NOLs that you generated can be used in any given year. And so some thought needs to be put into this corporate structure on when you're bringing investors on board, when they're buying stock in the company, to avoid having an ownership change occur that would limit the amount of losses that can be utilized, so that that hard-earned money that generated those losses can be used in the future to offset taxable income. The next structure I'm going to mention is an S corporation. And an S corporation is kind of a hybrid between a corporation and a partnership. It's like a partnership in the sense that it's a pass-through entity. The federal government does not tax an S corporation. So all the income and loss flows directly to the shareholders, and the shareholders of the company pay the tax. You can also get capital gain on the sale of stock. So this is more akin to the corporation. So when you sell corporate stock, you get capital gains. If you go out and buy shares of Google, you get them for a year, you will get preferential capital gains rates by divesting in that stock. Similarly, with an S corporation, you'll get capital gains on the divestiture of stock that you own in an S corporation. The upside to the S corporation is that when you sell it, and this makes it a little bit more appealing to investors, if you were to go to sell the business, you can create what's called a 338H10 election, which essentially says we're going to transform the sale of your stock in the company and treat it as if you sold all of the underlying assets. And what the appeal to that is to an outside investor is that they will get a step up in basis in what they just bought. So brief example, if you were to buy, you have assets worth $100 in a partnership, in an S corporation, and you sell a stock for $10, instead of just stepping into the shoes of the shareholder and getting the stock worth $10, you can make a 330H10 election and say, I just bought $100 worth of assets, which then through depreciation and other mechanisms, you can recover the cost of that investment. So this is a benefit to potential investors. The downside, making it next bullet says more difficult for investors. So the reason why this structure can be more difficult is because in an S corporation, there's only certain types of investors or shareholders that you can have. So a corporation cannot be a shareholder in an S corporation. For simplicity purposes, most of the investors or shareholders allowed in an S corporation have to be individuals. So if you have a corporation come in, that will taint the S corporation election, and you're going to be treated then from that point forward as a corporation. So the federal government made it so only certain investors can join an S corporation, and there's a maximum number of shareholders that you can have in an S corporation as well. Once again, the 199A deduction that I mentioned also applies to an S corporation as it does a partnership. And that's because it's a pass-through. There's one legal entity that I didn't mention here that's pretty popular, and that's an LLC, a limited liability company. Interesting, the federal government actually does not recognize an LLC. In the eyes of the IRS, an LLC does not exist as a tax vehicle, but when you create an LLC, the IRS allows you to elect and say whether you're going to tax the LLC as a partnership or if your members of an LLC are going to be taxed as a corporate structure. So if you create an LLC, you get to choose between being a partnership or taxed as a corporation. Those are your two options. All right, moving on to tax planning, and I tried to pull in some specifics that would be relevant to the startup community. So the research tax credit, in my eyes, is probably the biggest opportunity to take advantage of in the startup space. So what the IRS allows for is that if you are developing and doing research and developing a new product using hard sciences, so math, science, engineering, doing programming, you are going to be eligible for a research tax credit. Prior to 2018, this research tax credit was only eligible to offset income taxes. And so, as I mentioned, a lot of startup companies, they're not subject to income tax because they're not generating income in the earlier years. So in 2017, the tax law was changed to created this 41H, section 41H, which allows for the research tax credit to offset payroll tax. So this allows for startup companies to take an immediate benefit on the research they're doing and the credit they're generating to offset taxes. So it's claimed on the payroll tax withholding form that's remitted to the IRS, so it offsets federal payroll tax. And so all the credit that you generate for doing research can go to offset the federal payroll tax you owe dollar for dollar. The next thing to be mindful of is that a lot of companies or a lot of municipalities and jurisdictions, they have incentives to allow for and trying to persuade companies to start business in their jurisdiction. So the state of Texas was notorious for this a few years back, where they were allowing complete property tax abatement, state payroll tax abatement for companies to set up in their municipality. And so it can be driven down, countries will have their own. Right now, Poland is very aggressive trying to get research, companies doing research in their country. And so they will offer cash grants for companies to go to Poland and hire engineers to do research or programming. But it can be whittled down all the way to local municipalities and small cities trying to lure in companies. So before you make a decision on where you're going to start your business or if you're going to expand your business, it'd probably be worth a call to to your tax service provider, to EY, and ask us, hey, is there anything I'm considering, Atlanta, and I'm considering Nashville? Is there any benefit in the municipalities and these two jurisdictions from choosing one to the other from an incentives perspective? The other goodie here is the cash method of accounting. So all these startup corporations, S corporations, partnerships, they're eligible for startup companies to use the cash method of accounting. And what that does is it just eases your burden from doing accrual accounting, and it also provides more flexibility on creating deductions and deferring income. Because the cash method of accounting says you do not have income until you actually receive cash, and you can get a deduction as soon as you actually pay cash for something, which is dramatically different from the accrual method of accounting. I won't go into the details on the differences between these, but the cash method of accounting just does provide a lot of flexibility, and so it can help ease the tax burden by using this method. The other one is sales tax exemption. So if you're doing any sort of manufacturing, be aware that the products that you buy can be exempt from sales tax. And so you can get a sales tax exemption form that tells the city of Sacramento or wherever you're at that the product that you purchased is for an item that you're manufacturing. And so it's exempt from sales tax to save you on that 7.5% to 8% tax. The other one is you can deduct repairs versus having to increase the basis in a fixed asset by what the IRS would say is you're maintaining the asset or elongating the asset or prolonging the life of the asset, so you need to capitalize and depreciate it. Instead, you can take a repair deduction and recover the cost of that immediately. And then the last one is the foreign-derived intangible income deduction. This is relatively new. It came about as part of the Tax Cuts and Jobs Act in 2018. And this is the benefit to businesses that have foreign customers. So the IRS allows for an additional deduction if you're selling products overseas. If you remember during the campaign, President Trump was very big on bringing jobs back to America. And so part of the tax regime that they set up was that there's tax disincentives to having foreign subsidiaries or foreign businesses offshore. But if you are a domestic company and you're selling offshore, then you can get a tax benefit for doing so. So that's the good thing about having foreign customers. You can get an additional deduction for that. The CARES Act is the most recent tax package that came out related to this COVID-19 pandemic that we're facing. I'm aware that you guys have probably already had some of these other webcasts about the PPP loans, the Payment Protection Program. So I'll just mention it briefly. The PPP loan was a loan through the Small Business Association and allows for companies to receive a complete forgiveness of the loan as long as the funds are used for certain qualified expenditures such as rent and payroll. There's another option if you did not apply for or did not receive a Payment Protection Program loan, that you can defer your federal payroll taxes for up to 2 years. The other one is the Employee Retention Credit. So if you have employees that are still on your payroll, but that are not at full capacity and you've been affected by the COVID-19 crisis, you can get payroll tax credit for that. And then the last one is that if you are a taxpayer and you or have been a taxpayer in the past and the COVID-19 crisis has not been good for your business, as it is for most, you can take those NOLs that you've generated and carry them back to earlier years, which is a change in the tax reform package that disallowed the carryback of NOLs. So those are some of the items that came about from the CARES Act that fall under the tax umbrella. So some things to be aware of. So GILTI, this is the regime that came about as part of the Tax Cuts and Jobs Act, which disincentivizes companies from setting up subsidiaries offshore. The GILTI regime essentially says, we're going to tax all of the income that your subsidiary generates in the year that it is generated. So it really eliminates the opportunity to defer taxes on earnings from a foreign subsidiary. Subpart F is similar in nature. This is just income that is generated offshore that the IRS is going to tax you on now. The Wayfair cases related to sales and use tax probably got a lot of attention right when it came out, and I feel like the startup community needs to be aware of this. What the Wayfair case did is essentially said, related to sales tax, if you are selling product into another state, regardless if you've ever stepped foot in that state, you may have created an economic nexus in that state and are subject to paying and remitting sales tax on your products in that state. What this Wayfair case did is it created this economic nexus for sales and use tax, which is then carrying over to the income tax regime, where states are saying, including the state of California, California says, if you've never, so previously, you only had to file income tax or sales and use tax returns in the states where you're actively doing business, where you have property, where you have an employee hired, where you go frequently to travel to visit customers, do maintenance, what have you. But the Wayfair case changed that and said, so California says, if you do more than $500,000 worth of sales into our state, regardless if you've ever stepped foot in the state of California, you have an income tax filing requirement into our state. And all the other states are piggyback off this because they all want money. So they're all saying, if you are doing business in our state, meaning if you've done a certain volume or threshold of sales into our state, we want you to file tax returns. And so on the sales tax side, that may mean if you get new customers in a certain state, you need to be mindful that you need to start collecting and remitting sales tax. So these are the non-income tax items. So sales and use tax, which I just mentioned, it's not just for tangible property. So if you are a software as a service company, or you have some sort of digital technology that you are providing to customers, this can be subject to sales and use tax in certain jurisdictions in the United States. Payroll tax is always one to be mindful of. I've seen 2 startup companies that had significant blunders with their payroll tax. They were trying to do some cash tax planning and did not remit their payroll tax to the federal government. In the eyes of the IRS, that is essentially like directly stealing from the federal government, and so they don't not treat kindly to that. So make sure you have your payroll tax in order. Value-added tax is a tax regime abroad. So if you have foreign customers, there's a good chance that especially in Europe, that there's a value-added tax associated with that, with selling abroad, and that you may be subject to this value-added tax. And then the last one is just property tax, that is a state or city tax that you need to make sure that all your fixed assets that you have, you're reporting and paying payroll property tax on those. To conclude, I got a couple jokes in here. So Jay Leno, he said, worried about an IRS audit, avoid what's called a red flag. That's something that the IRS always looks for. For example, say you have some money left in your bank account after paying taxes, that's a red flag. And then the last one is from Albert Einstein, who we all know. He said the hardest thing in the world to understand is the income tax. So they're going to get you. Just be mindful that there is a lot that falls under that income tax umbrella or the tax umbrella, and we're here to help you out. So I'm happy to answer any questions that you may have, and I appreciate you guys' time.